Whenever I talk to people about notes, the most common feedback I receive is that sounds too good to be true. Where's the risk? And so today, in the spirit of transparency, I want to address that. The bottom line is all investments carry risk, and I'm not here to tell you that note investing is any different. What I will say is that it does carry lower risk than more popular forms of investing if done correctly. So with that being said, let's jump right into it. Most of your risk as a note investor is going to come in the due diligence phase. You want to do extensive due diligence before investing to make sure that you're going after a healthy asset, and that starts with the property. When you're looking at a property, you want to make sure that it's in good condition. A great idea is to send a local realtor by to put eyes on the property. They're looking for damage, they're looking for bars on the windows, they're checking out the neighborhood to make sure that it's safe. They want to see the proximity to schools and stores and things that people would use, but most of all, they want to make sure that the property is in good condition. It'd be a real shame to invest in a note on a property to find out the property burned down a month before you purchased it. In addition to looking at the property condition, you also want to look at the property value. You can do that pretty easily by looking at Zillow, Redfin, sites like that to check the property value and relatable comps in the area. By doing this step of the due diligence, you'll get a good feel for the property that your note is associated with, so that in the event of default, if you have to claim the property as collateral, you know that you're claiming an asset that someone would want to buy. The next thing you want to look at is the borrower qualifications. Remember, as note investors, we're buying loans, and so we want to make sure that we're buying loans that people can afford to pay back. That means looking at people's credit, their income, bankruptcies. It can feel a little invasive, but it's really important before you go and put your money up to buy their note. In addition to that, you want to look at any information you can get on the borrower's interactions with the previous note owner. Are they difficult to deal with? Do they pick up the phone? If they miss a payment, how quickly do they catch up? All of this stuff is important before you go buy a note, and it can impact the price that you pay on a note when it's time to make a bid. The last thing you want to do in the due diligence process is check the paper trail. You want to make sure the property has a clean chain of title, that nobody else has a lien on the property so they can claim that they own it. You want to see if the taxes are kept up to date, if the property has proper insurance. All of this stuff is very important before you go and put your money down on a note investment. By doing thorough due diligence, you eliminate a lot of the risk right off the bat. If what you're seeing doesn't meet your qualifications, it's okay to pass. There's plenty more opportunities out there. The second thing you want to do to mitigate your risk when investing in notes is buy with a significant equity cushion. That means buying notes at a discount. Let's say you're looking at a note that's being offered at $50,000. The property it's collateralized by is worth $80,000. If you could buy that note at $40,000 or $35,000, you've already made money right off the buy. And if you had to resell that note, you could probably sell it for more than you paid for it. That right there is excellent risk mitigation and something you should always consider doing when you're looking at note deals. The third and final point I want to make about risk mitigation is building a strong and skilled team. The best way to win is to play to your strengths, and that means outsourcing the work that other people are better at. That means finding a great lawyer to handle the legal part of note investing, finding a great asset manager to keep in contact with your borrowers, maybe even finding someone who's really good at analyzing deals to only bring you the ones that meet your qualifications. By following these practices, you can do a lot to mitigate your risk when investing in notes. It's already a low-risk strategy because you're investing in an asset that's collateralized by a more valuable asset, but that doesn't mean there's no risk at all. The more thorough you can be in your process, the safer you can sleep at night, knowing that your money is safe and your investments are going to continue to grow. I look forward to talking to you next time. Until then, happy investing.